Hello, everyone. Welcome to the market opening bell on Friday, September 5th, your 10-minute guide to the stock market. Hong Kong stocks fell with the Hang Seng Index opening 145 points higher before turning downward, dropping as much as 330 points to 25,013 in the afternoon and closing down 284 points or 1.1% at 25,058. The H-share index fell 112 points or 1.3% to 8,937, while the Hang Seng Tech Index dropped 104 points or 1.8% to 5,578. Total market turnover was $302.2 billion. Southbound funds recorded a net purchase of $706 million in Hong Kong stocks, including net buys UB Tech $827 million, Xiaomi 702 million, Alibaba 550 million, Meituan 526 million, Sinuk 512 million, Horizon Robotics 401 million, Yangtze Optical Fiber and Cable 105 million. Net sales SMIC 1.158 billion, Hua Hong Semiconductor 688 million, Kuaishou 541 million, Tencent 336 million. According to statistics, southbound funds have net bought Alibaba for 10 consecutive days, totaling $17.378 billion, while net selling SMIC for 3 consecutive days, totaling $2.305 billion, and Hua Hong Semiconductor for 3 consecutive days, totaling $2.108 billion. Technically, the Hang Seng Index has repeatedly failed to break through 25,700, retreating to near 25,000 yesterday, continuing its volatile market trend. Reports indicate that Chinese financial regulators are considering measures to cool the stock market, leading to significant declines in mainland markets. The Shanghai Composite closed at 3,765, down 47 points or 1.3%. The Shenzhen Component Index fell 353 points or 2.8% to 12,118, and the Chinex Index dropped 123 points or 4.3% to 2,776. Total turnover in Shanghai and Shenzhen markets reached 2.54 trillion yuan. The renminbi US dollar central parity rate was raised by 56 points to 7.1052. Since April, Chinese stock markets have seen a notable rebound, with major indexes up over 20%. The Shanghai Composite hit a 10-year high. Recent proposals to cool the market, including lifting some short-selling restrictions and curbing speculative trading, have been submitted to regulators due to concerns about potential heavy losses for retail investors if the market reverses sharply. It remains unclear whether these measures will be approved. Sources say regulators have identified investors using funds borrowed from online lending platforms to enter the market, and banks have been asked to investigate the misuse of credit for stock investments. Additionally, brokerages have been ordered to stop heavily promoting round-the-clock stock account openings, and social media platforms have been told to avoid excessively hyping bullish markets, margin trading highs, or encouraging bank deposit shifts to stocks to prevent stimulating novice investors. Any violations or unauthorized stock recommendations will face severe penalties. Agricultural Bank of China's A-share surged 5.17% yesterday, marking the largest single-day gain since May 2023, nearly a 2-year high. Its total market capitalization rose to 2.55 trillion yuan, surpassing ICBC's 2.49 trillion yuan, making it the top A-share by market cap. Year-to-date, Agricultural Bank's market cap has grown by 721.9 billion yuan, the largest increase among A-shares. In Hong Kong stock news, following multiple price hikes by mainland paper mills in August, leading companies like Nine Dragons Paper, Lee and Man Paper, Shanying International, and Wuzhou Special Paper recently issued price increase notices, raising prices for certain products from early September. Reports suggest that with the traditional peak season approaching and paper mills adopting a dual strategy of price hikes and production halts, the upward trend in paper prices may continue. Looking ahead, the paper industry's supply-demand dynamics are expected to improve, with Mid-Autumn Festival, National Day, and an e-commerce peak season restocking, boosting downstream demand. Meanwhile, central authorities are pushing to address inflation-style competition, which should improve the supply-demand balance, potentially restoring profitability for advanced paper companies. Reports indicate BYD has cut its 2025 sales target by 16% to 4.6 million vehicles, signaling the slowest sales growth in nearly 5 years. Sources say BYD has repeatedly lowered its target internally, with last month's communications to specific suppliers confirming a goal to secure 4.6 million units for the year, though this may still be adjusted based on market conditions. The revised target is below recent analyst estimates of 4.7 to 4.8 million units. The new target represents just a 7% increase from last year's actual sales, the slowest annual growth since 2020, when sales fell 7% year-on-year. US stocks opened lower but closed higher. The Dow Jones rose 350 points or 0.8% to 45,621. The S&P 500 gained 53 points or 0.8% to 6,502, hitting a new closing high, while the Nasdaq climbed 209 points or 1% to 21,707. The Nasdaq Golden Dragon China Index, reflecting Chinese ADRs, fell 87 points or 1.1% to 7,751. Individual tech stocks rose, with Amazon up 4.3%. Meta and Tesla gained over 1%, while Apple and Nvidia rose 0.6%. On Nvidia, reports suggest that despite Chinese regulatory pushback on purchasing its AI chips, companies like Alibaba and ByteDance are keen to secure Nvidia chips due to limited domestic supply from firms like Huawei and Cambrican. They hope for government approval of Nvidia N20 chip orders. Chinese tech firms are also closely monitoring Nvidia's more powerful Blackwell-based B30A chip, which may cost twice as much as the H20, priced at 10,000 to 12,000 US dollars. However, they see the B30A as cost-effective given its expected six-fold performance improvement over the H20. Cloud software company Salesforce issued disappointing third-quarter revenue guidance, with its stock closing down 4.9%. On the earnings front, Broadcom reported third-quarter revenue up 22% year-on-year to 15.96 billion US dollars. AI-related revenue shone, rising 63% to $5.2 billion. Adjusted earnings per share were $1.69, beating market expectations of $1.66. The company expects fourth quarter AI revenue to grow further to $6.2 billion. Its stock rose 3% after hours. Lululemon reported second quarter net profit down over 5% year-on-year to $371 million US dollars, with earnings per share of $3.1, beating expectations of $2.88. Revenue was $2.53 billion US dollars, slightly below the expected $2.54 billion. Gross margin fell 1.1 percentage points to 58.5%, and operating margin dropped 2.1 percentage points to 20.7%. America's comparable sales fell 4%, with overall comparable sales up 1% below the expected 2.2%. The company forecasts tariffs will reduce full-year profit by $240 million US dollars, with annual earnings per share projected at 12.77 to 12.97 US dollars, well below the expected $14.45, and revenue at 10.85 US dollars to $11 billion, below the expected $11.18 billion. Its stock fell 14% after hours. Apparel brand Gap announced plans to introduce beauty and personal care products at 150 Old Navy stores later this year, boosting its stock by about 5%. The Institute for Supply Management (ISM) survey showed the U.S. services PMI rising from 50.1 in July to 52 in August, exceeding expectations of 51 and hitting a 6-month high, driven by faster growth in business activity, 55, new orders, 56, and inventories, 53.2. Other positive indicators were offset by ongoing employment contraction, 46.5, a 16-year low in backlog orders, 40.4, and rising prices, 69.2. Additionally, S&P Global Service PMI business activity indexes fell to 54.5 in August from 55.7 in July, below the preliminary reading of 55.4, indicating slower but still significant U.S. services output growth. August reading was the second highest in 2025 so far. On employment data, ADP reported U.S. private sector job growth of 54,000 in August, below the expected 65,000, with July figures revised up to 10,600. U.S. initial jobless claims rose by 8,000 to 237,000 in the last week of August, the highest in over 2 months and above the expected 23,000. The U.S. will release August non-farm payroll data tonight, with expected job growth of 78,000, up from 73,000 previously, and on an unemployment rate forecast to rise to 4.3% from 4.2%. Our stock pick today is FWD Group, stock code 1828. FWD Group is a pan-Asian life insurance company with operations in Hong Kong and Macau, Thailand and Cambodia, Japan and emerging markets including the Philippines, Indonesia, Singapore, Vietnam and Malaysia. This geographical coverage provides the group with growth opportunities in developed insurance markets such as Hong Kong and Macau and Japan, while also offering access to Southeast Asia, including some of the world's fastest growing population, expanding yet underinsured markets. For the first half of the year, ending June 30, 2025, FWD Group's new business sales, measured by annualized premium equivalent, rose 38% year-on-year to $1.246 billion. The new business contract service margin reached $794 million, up 34% year-on-year. Operating profit after tax grew 9% to $261 million, with all 4 regional business segments continuing to contribute positively to the group. Net profit was $47 million, marking a new high for interim results since the adoption of IFRS 17. Total tangible equity increased 8% to $8.15 billion, and embedded value rose 8% to $6.38 billion. The group plans to use the net proceeds from its initial public offering to further enhance capital strength and financial flexibility, including reducing overall debt to support growth and expand customer and channel penetration. Earlier this year, the group completed the establishment of an Asian high net worth client service network, aiming to serve the global high net worth insurance market through diversified asset allocation, wealth management, and legacy planning. Macro factors such as structural population growth, middle class expansion, ongoing wealth accumulation, and significant protection gaps are key drivers of growth in the pan-Asian insurance industry. According to statistics, the total underwritten premiums of life insurance companies in the group's current markets are expected to grow from approximately $407 billion in 2023 to $579 billion US dollars by 2033, presenting significant market opportunities. Recommended buy price is $41.5 with initial target at $44.5, followed by $46 and stop loss at $39.5. I do not hold the aforementioned stock.